Here to break that down, I want to bring on our first guest today. Dan Niles is the founder of the Satori Fund, portfolio manager as well. He rejoins us here. And Dan, I mean, when we're looking at this, it's interesting because you can talk about this fund having some problems right now. Your fund, you say, up double digits for the year, having its best start in 17 years. And interesting to see you come out and talk about maybe dipping your toe in some of the stocks that this fund was exposed to, including and mainly being Viacom. So talk to me about maybe the opportunities you're seeing here. We already talked about bank stocks seeing a bid today, Viacom up by about 5%. So what are you seeing there?
Yeah, so I think the great thing about capital markets is what's a problem for one fund can be a huge opportunity for another. And so if you look at a lot of these names that got liquidated, and there's sort of 9 of them, and we talk about this on danniles.com where we wrote up an article around Viacom. If you look at what happened with many of these names, like Viacom was down 50% in 4 trading days, over 50%. And a lot of the other names got hit pretty hard as well. And so for us, you know, we've written on Viacom back in September of last year saying it was an underappreciated streaming play, an undervalued streaming play. And, you know, that was clearly the case. Now you can certainly argue, which I would, that at $100 a share, the stock was overvalued. But, you know, in the 40s, I mean, it looks very, very interesting to us. And you can say that about other names. We put out a tweet yesterday under my handle at Daniel T. Niles talking about how we got involved in Baidu as well. We in fact own 4 names now that were in that liquidation bucket of names that got blown out because of of the fund that got liquidated in Asia. And so for us, it creates a really interesting buying opportunity where we think, you know, Baidu's got potentially 50% upside from here, given the value of the different businesses that they have. And, you know, likewise with Viacom, we think there's a lot of upside as their streaming business continues to grow. So for us, you know, we bought some Viacom on Friday. We doubled the position yesterday. We're buying more today. We're adding to our Baidu position as well today. And we're, you know, buying another name that was in that basket that got blown out. So, you know, we like this. I mean, it's all risk versus reward. They're the 2 sides of the same coin.
Yeah, Dan, when you consider the sell-off that we've seen in some of those names you just mentioned, certainly there's been a lot of attention on the downside to that, given what has played out with Archegos over the last several days. But I wonder how much of the price action over the last few months you can peg to the buying coming in from Archegos. And if that's the case, does that change your thesis for a stock like Baidu, for example?
No, not really, because I think, you know, for us, we sat down and analyzed Baidu and we looked at it and we said, okay, if you put a 15 multiple on the ad business, you know, you can almost get to the entire value of the company off of that. And then you've got publicly traded companies that they're invested in that add another $50 a share to the price. Their electric vehicle autonomous driving efforts add probably another 50, and you put their cloud business in there, that's, you know, probably $60, $70 of value. And so you add all of that up and you go, wow, you know, this thing looks pretty undervalued. And the great thing is you got a fantastic fire sale opportunity in this name where the price was determined by something other than the fundamentals of the company. Now, to your point, clearly some of the bid up was driven by Archegos, but, you know, you always have funds buying and selling. The only reason you know about them is because they were forced into liquidation. I mean, last year, I'm sure they had a great year because a lot of these stocks got run up not only from what they're buying, but, you know, you had the meme stock mentality as well in some of these names. So you have a lot of things. There's always buyers and sellers. It's just we know about this one. But quite honestly, the financial system handled it great. This is not like long-term capital management in 1998 where the Fed had to come in and do a rescue. And if you look at the charts for the entire stock market, you couldn't even tell there's a problem. The S&P is, you know, a few percentage points off its all-time record high after a great year last year. So, you know, the financial system works great, and it's just, you know, you try to take advantage. I try to buy low and sell high. I'm not a momentum chaser. So for me, you know, having a good view on these names, you know, I think I have a decent margin of safety in buying them, and that's why we're buying more of these names today.
Yeah, I mean, it's interesting when you step back and kind of look at the relative suggestion in terms of putting together the perfect portfolio. I know you've moved away from some of those tech names. You still have 2 big tech companies that you see maybe benefiting from the recovery in the months to come, being Google and Facebook. But talk to me about where you think we're at, given maybe the expectations that the Fed's going to be coming off the gas a bit sooner than maybe people were expecting just a few months ago.
That's a great question, Zach. I mean, we've obviously anniversaried the lows of COVID in terms of the stock market. And so now the comparisons start to get more difficult going forward. And to your point about the Fed, and we wrote an article on this, I mean, the Fed really has started to stealth tighten, as I called it, when they did not extend the bank's supplemental leverage ratio. And to put it in English, that just means banks have to have more capital on their balance sheets to actually protect against things like what happened with Archegos. So, they've sort of started a de facto tightening process. I think what you're going to see is by the time you get to the end of this year and inflation has really picked up, when we've all been vaccinated and we're all traveling and going on vacation and driving places, et cetera. And I think they're going to force to actually have to taper that 120 billion in bond purchases they do a month. And that's going to cause a major problem in further rotation. And with valuations up at 1.8 times market cap to GDP for the entire stock market, by the way, during the bubble in 2000, that was at 1.4 times. You don't have a lot of room for error. And it's really been stimulus that's been driving this market for definitely since COVID. And you could argue for 13 years since 2008 when we had the global financial crisis.
Yeah, and I mean, when we think about maybe that coming, you say by the end of 2021 in terms of them saying they're not tapering yet in their public comments, but when you look at kind of the actions, it speaks a little differently, that public acknowledgement of maybe what they're doing coming by the end of the year. But when you think about maybe that being beneficial to some of those other plays you've talked to us about on the show, mainly the XLE and some of your other picks there, which ones are you expecting to maybe see the largest benefit from there when you think on a sector basis?
Sure. I think from a sector basis, obviously, if we're flying places, we're driving. I think energy stocks will continue to do well. I think bank stocks, as the economy picks up, you've got GDP growth potentially around 7%, the fastest since 1984. Loan growth should start to pick up for those companies. Obviously, a lot of free money out there, so they'll benefit. But I think some of the traditional, quote unquote, legacy tech companies will also do very well. I think Cisco will do well as we go back to the office and companies have to start spending again on that corporate infrastructure. I think Ericsson, we just had $90 billion spectrum auction. We're going to be building out the 5G networks, these big telecom carriers. I think they'll do well. And then, Oracle is one of our top 5 picks for this year. And we continue to believe that they're going to see their revenue start to accelerate, driven by the cloud. So we're not in a lot of the high multiple names. Every one of those names I mentioned, for the most part, has a multiple below the market with the dividend yield above the market. You brought up Facebook and Google. Google has 10 to 15% of their revenues in travel. That, the spending there should obviously come back. So they'll be a big reopening beneficiary. And Facebook, just because, all their business is obviously ad driven. And so they're going to benefit as companies advertise more. So, that's the sort of grouping of names that we like quite a bit as we think about the rest of this year. They're defensive as well as having value, but they benefit from reopening. And I think that's where you want to be if rates, 10-year treasuries, we think will go above 2% before the end of this year. You don't want to be in high multiple momentum names in that kind of environment.
Yeah.
Dan, I'd love to get your thoughts on the growth that we've seen around these family offices, which, of course, Archegos is. EY had some numbers out in a report that suggests private family capital now exceeds private equity and venture capital combined. How much of that growth do you think has come from the increased scrutiny on larger hedge funds? And ultimately, how much risk does that inject into the market?
Yeah, I don't think there's that much. I mean, you always hear about the bad actors, right? You're not going to hear about the thousands of family offices that are doing what they're supposed to and are not playing with high leverage. So I don't think it's a big deal. I mean, you've seen how the market has reacted. You couldn't even tell there's an issue going on, other than the fact we're talking about one particular fund and a group of sort of 9 stocks in particular that were in forced liquidation because of that. So yes, it makes great headlines. The politicians will get up there and grandstand and talk about it. But at the end of the day, all the regulations put in after Lehman happened, those have worked well. That's why you're not seeing a big issue with most of the banks other than the ones that have direct exposure to this. And, and they knew what the positions were at this fund. That's why they all got together and tried to figure out how to, liquidate this. And what you could argue is when the leverage started to tick up to 5 times, 6 times, 7 times, 8 times, they should have gone in there and said, look, yeah, you're making tons of money. These stocks are all going vertical because the Fed's pumping money into the system, and we've got 1.9 trillion in stimulus that's been approved and all this stuff. But, we think the leverage is too high. And that's maybe where the banks that were involved with them should have stepped in to cut this back. But, that's a slightly different issue, I think, in my mind.